There's one simple shift you can make today that could instantly improve your technical trading, more than anything else. And that is, using a solid top-down analysis approach. If there's no clear step-by-step process to your top-down analysis, then you might as well be gambling. You only see part of the story, and that leads to unnecessary losses, trades that could have been easily avoided. But when you start your analysis from the higher timeframes and work your way down, everything clicks. You get a much clearer view of the market, understand where price is likely headed, and you position yourself with the trend, not against it. The result? Fewer small losses, more confidence, and better quality trades with stronger results. In this video, I'll guide you through the exact steps to build a powerful top-down analysis framework, so you can trade smarter, not harder. So what is top-down analysis? Top-down analysis is all about combining multiple timeframes and key market factors to build a complete picture of what's happening in the market. By looking at the bigger trends first and then zooming into the smaller details, you gain a much deeper, smarter understanding of market conditions, and that gives you a major edge as a trader. Top-down analysis is all about moving from the higher timeframes to the medium timeframes, and finally down to the lower timeframes to build a full, detailed picture of the market. Now let me show you our top-down analysis technique step by step, which is the process of going through a higher time frame and scaling down to the lower details. To identify best trading opportunities, we consider three types of time frames in our chart analysis: higher time frames, medium time frames, and lower time frames. Starting from higher time frames, each time frame plays a different role. Higher time frames help us set our directional bias, giving us the clearest view of the overall trend. We use to identify higher time frame key levels of the market structure. If we can determine that the market is bullish on the higher time frames, we instantly put the odds in our favor for finding higher probability trades. Medium time frames are where we start to fine-tune our setups. Here, we narrow down key areas such as order blocks, liquidity zones, and trading opportunities, and identify trading ranges where opportunities might emerge. Lower time frames are all about execution, setting up our entries, placing our stop loss, confirming setups, and planning out targets. Each layer, high, medium, and low, has its own specific purpose and needs to be respected. Now, something important to remember. Markets are fractal by nature. Meaning, whether you're looking at a weekly chart or a 5-minute chart, you'll see similar patterns, similar trends, and similar price action behavior. Because of this, high, medium, and low are relative, depending on your trading style. Whether you're a day trader or a swing trader, the logic behind top-down analysis stays exactly the same. Another key point is time frame relevancy. You don't want to jump from a weekly chart straight down to a 15-minute chart. The gap is way too big. What looks like a bullish trend on the weekly might look like a bearish trend on the 15-minute, and mixing them would only cause confusion. Instead, you want your time frames to align smoothly. Start with the weekly, then the daily, then the 4-hour, then the 1-hour, and finally the 15 or 5-minute. This way, what you see at each level naturally flows into the next, giving you a consistent, logical structure to base your trades on. So, here are the top 3 reasons for combine multiple timeframes. Reason 1. Overcoming directional confusion. Sometimes, when you look at a lower time frame, like the 1-hour chart on Euro, the market looks messy, constantly breaking structure up and down. It feels completely random and confusing to find any real direction. But when you zoom out to the 4-hour time frame, things start to make sense. You can clearly see the overall bullish pressure. Interestingly, the same area that looked chaotic on the 1-hour chart is actually part of a clean bullish trend when viewed from the 4-hour chart. When you know the higher time frame bias, you can enter buy trades confidently on the lower time frames, without second-guessing yourself. If you ever feel lost because price keeps breaking key structure levels, chances are you're stuck on the wrong time frame. Zooming out gives you the bigger picture you need to make better, more precise trading decisions. Reason 2. Increasing trade accuracy. A minor reaction at a higher time frame key level can completely flip the trend on lower time frames. That's why it's crucial to check the higher timeframe zones before taking any trade. For example, on the 1-hour chart of euro, you might spot a strong bullish move with a clear fair value gap and an attractive demand order block. Everything looks perfect for a long setup. But suddenly, price reverses sharply and invalidates the demand zone. What happened? When you zoom out to the daily timeframe, you'll see that chart is bearish and price had actually tapped into a major higher timeframe FVG. That explains the sudden shift. Always check for major PD array zones on the higher timeframes before entering a trade. It helps you set smarter stop losses, target better exits, and avoid getting caught in risky moves. Reason 3. Maximizing risk-to-reward ratios. When you align your trade entries with the higher timeframe structure, you naturally set yourself up for better risk-to-reward opportunities. Let's say you find a great setup on the 5-minute chart, maybe a perfect fair value gap or a clean change of character. If that setup also aligns with a major higher timeframe zone, like a 4-hour or daily demand, your trade has a much higher probability of succeeding, and you can aim for bigger targets with more confidence. On the other hand, if you enter trades blindly without checking the bigger picture, you might end up taking setups that offer poor risk-to-reward, or worse, you could be trading directly into higher timeframe supply or demand levels, setting yourself up for failure without even realizing it. When you combine multiple timeframes correctly, you don't just improve your entry quality, you also dramatically boost your risk-to-reward ratios, which is the true secret to long-term trading success. Alright traders, let's quickly recap. Higher timeframes give us clear directional bias and help avoid confusion. Checking major zones on bigger timeframes increases the accuracy of our trades. And aligning our entries with higher timeframe structure helps us maximize our risk-to-reward potential. By combining multiple timeframes the right way, you put yourself in sync with the bigger market moves, instead of fighting against them. Now that you understand why top-down analysis is absolutely essential, it's time to dive into the step-by-step process of how to actually do it. Alright, let's get into the actual process. Step 1. Start with the higher timeframes. We always begin by looking at the bigger picture, usually the daily or even the weekly chart, depending on your trading style. At this level, we're asking two main questions. Is the overall trend bullish, bearish, or ranging? Are there any major PD array zones nearby that could impact price? This gives us our directional bias, the foundation for everything we're about to do next. Step 2. Move to the medium timeframes. Once we have our high timeframe bias, we drop down to the 4-hour and 1-hour charts. Here, we're looking to refine our analysis. Where are the clean structure points, the swing highs and lows? Are there clear fair value gaps or order blocks forming within our bias? Is liquidity building up that could soon be taken? This is where we start identifying potential trade setups and building the story. Step 3. Fine-tune on the lower timeframes. Finally, we move into the 15-minute or 5-minute charts. This is where we actually plan our entry, stop loss, and targets. On lower timeframes, we look for precise liquidity sweeps, confirmations like change of character, small fair value gaps or order blocks to refine our entries. The goal here isn't to find a new direction, it's simply to execute based on the bias and setup we already identified from the higher timeframes. At every step, always ask yourself, does what I'm seeing align with the bigger picture? If it does, great, you have a high probability trade. If not, stay patient and wait for a better setup. Alright, let's bring everything together with a real example. Let's say we're analyzing euro. First, we open the weekly chart. What do we see? Price is making higher highs and higher lows, clear bullish structure. After grabbing liquidity and tapping into a fair value gap, the market has gathered the fuel it needs to continue pushing higher. So, from the weekly chart, we have a bullish bias. Now we switch to the daily chart. On the daily timeframe, price made a strong bullish move with momentum, creating two clear fair value gaps along the way. Okay, it's good. Now we switch to the 4-hour chart. Now on the 4-hour chart, after that strong momentum move, we can see that price is slowly climbing upward, but with a lot of choppy, up and down movements. This kind of price action is building liquidity below the swing lows. And right beneath that liquidity, we have some very clean fair value gaps, which could act as ideal zones for potential entries. So what does that tell us? Well, when price is moving slowly like this and building liquidity below, it's often a sign that the market is preparing to sweep that liquidity, taking out those early buyers before making its next big move. Now let's drop down to the 15-minute chart to look for a precise entry. At this level, we're waiting for a liquidity sweep above one of those FVGs that we saw on the 4-hour chart. Once price takes out the liquidity and taps into one of our clean fair value gaps, that's when we start watching for signs of a reversal. Here, price dip into one of those clean fair value gaps, grab liquidity, and create a change of character. That's exactly where we want to look for our entry model. We can place a long entry inside the new FVG, set our stop loss below the sweep, and target the next internal high or 4-hour structure level. This way, we're trading in line with the higher time frame bias, using smart money concepts, and positioning ourselves with a great risk-to-reward setup. And that's exactly how you apply top-down analysis to get a clear, structured, high-probability trade. And that's it for today's video. I hope this breakdown gave you a clear idea of how to use top-down analysis to sharpen your trades and avoid unnecessary losses. If you found value in this content, make sure to hit that like button. It really helps the channel grow and lets me know you're enjoying these deep dives. Also, don't forget to subscribe and turn on notifications so you never miss out on more smart money concepts and trading strategies. Got any questions or topics you'd like me to cover next? Drop them in the comments below. I'm always happy to help you level up your trading game. Thanks for watching, and as always, stay disciplined, stay patient, and I'll catch you in the next one.